Over the years, in my work with doctors and other professionals, I've always seen a ton of interest in folks using cash value life insurance specifically to invest in real estate. To start, a few questions. Has anyone ever tried to sell you whole life insurance before? All right, we got a couple. Have you ever heard that it's a bad place for your money or it's a scam? Have you ever heard it's a great place for your money? But that banks, corporations, wealthy families own it? Maybe. Have you ever heard of using a whole life insurance policy as your own bank to invest in real estate? We're going to dive into some detail. So what does that actually mean, to use a whole life insurance policy as your own bank? Well, simply put, it means that you're going to get loans from a life insurance policy instead of going to an actual bank. To illustrate, it'd be like buying a property with cash. If you've got a ton of cash, you don't need to go to a bank for a loan because you can finance it yourself. Except, you'll find there's a big advantage to using a life insurance policy instead of cash, which we'll cover in detail. So question, why would anyone use a life insurance policy as their own bank? Let's answer that question with a question. You ever get frustrated with banks? At least once or twice in your life, maybe a lot more. Let me know if you've ever experienced anything like the following. You see an investment property. You want that investment property. You apply for a loan with the bank. The bank comes back. They undervalue your property. The payment schedule, not convenient at all. The interest rate's way too high. You've got to show them your life history multiple times, and it takes forever to get approved. And then you feel like this guy. Ever been there? Maybe. So using a whole life insurance policy reduces a lot of that stress, often that people feel when working with an actual bank. So how does it work? Using a life insurance policy to buy real estate. At a very high level. Step one, I would get a whole life insurance policy. However, the focus is not on life insurance. It's on the cash value. The cash value might grow by about 5% per year. And I take a loan from that life insurance policy to purchase real estate. Here's the key on this. My money still grows by 5%, even the money that I borrowed. And then I take that money and I purchase real estate, which also earns a return. Many have expressed over the years that using a whole life insurance policy is a faster and easier method than working with a bank. Want to compare the two? Let's start with a bank. Firstly, I've got an approval process. I might be denied. The loan amount is determined by the bank. I have to have credit. It's going to affect my credit. The interest rate is set by the bank. There's possible closing costs, fees. I've got to pay the loan back on the bank's terms, and it takes forever to get approved. I feel like him again. Versus a life insurance policy. There's no approval process. I'll always get my money in 2 to 3 business days anytime I request a loan for my policy. I cannot be denied, and the maximum loan that I can take is always based on whatever I have in my cash value. There's no credit check, no impact on my credit score. You'll find that both fixed and variable loan rates are available when I start the policy. There's no fees, closing cost, or payment plan requirements. You get your money fast. It's extremely convenient. You'll find you can use a mobile app nowadays with most companies, and you're in control. Not a bank, not even the insurance company. So why people we work with typically use life insurance to invest in real estate is because they get their money fast, it's convenient, and they control everything. So what people we work with typically do is firstly, stop working with a bank. Now, sometimes this is sudden if they have the means. In many cases, it's a gradual process as they continue to build up the values of their policy. When they stop working with an actual bank, meaning a banking institution, in concept, they're creating their own bank. And what that means is that they're taking loans from the cash value of a life insurance policy. That's all it is. We're going to go into a lot of detail though. So here's what we'll cover. First, we'll share stories of clients we've worked with for years, and specifically how they use real estate or how they use life insurance to invest in real estate. Then we'll talk about the safety, liquidity, and tax-free benefit that comes with the product. Then we'll talk about how to get life insurance right. Specifically, what not to do versus what to do. This is probably the most important piece of the presentation. And then we'll go through a detailed case study that will analyze the numbers, if you like numbers, so you can see exactly what it looks like when you borrow against that policy to invest in real estate. Does it actually enhance my returns? We'll see. The goal of today's presentation is to teach you how cash value life insurance can help you grow your money safely, help you grow your money tax-free, and improve your overall returns on your real estate investments. Sound good? All right. Before we continue, a little bit about me. Hello, my name's Steve. If we haven't met, look forward to speaking to you later this evening and tomorrow. We'll be around all day. That's a picture of me and my lovely wife, Tara, who's not able to make it this time, but maybe in the future. In my free time, I like to teach about 40,000 people all about whole life insurance with a specific focus on the cash value. We've got a little bit more than 100 detailed case studies that do focus on real estate, entrepreneurs, and business owners. Now, I am the founder and CEO of IBC Global. We currently serve about 3,000 clients, many of which have 7-figure, 8-figure, even 9-figure net worths. And one of our largest clients is a bank, which I'm going to share exactly what they do today. Our firm also serves doctors who own their own practice and are W-2 employees that typically have an interest in using their money, in many cases, for real estate, but sometimes their practice as well. And our mission as a company is to make the best products and solutions available to everyone, both individuals and institutions. Now, I promise all of that is true. And if you'd like to have a conversation about life insurance, do my best to keep it interesting. Now, before I started the company, I worked at what was called an executive benefits planning firm. What does that mean? Well, sometimes it was boring, but I really like the numbers. I helped corporations purchase life insurance, and their focus was on the cash value. I didn't sell it. I was a back office guy, and my job was basically to make sure a corporation putting away millions of dollars per year had as much cash value as possible. And also, my job was to make sure we followed IRS rules and make sure they can access it tax-free. Because you can really mess it up, and then you lose the tax benefits. But I was working here where I learned specific details, firstly, on how to maximize the cash value of a life insurance policy. I learned the why behind why corporations and banks put millions, in many cases billions of dollars into these products. Now anyone can copy them. And then also what life insurance companies to choose. And after learning a lot about life insurance and the fun cash value piece, I decided to go off and start my own company. And that is the actual location where I started. You can see my ride to work. I still wanted to put on the professional look, so I spent my money on a suit and tie, and I took a 4-wheeler into work every day. I'm kidding, I didn't do that. But that was my office. So I worked out of that office about like 25% of that garage. And it was me and my friend Becky initially, who was a part-time assistant. Now, since then, we actually still have that building and another one. That building, though, you would not recognize if you came by today. We've renovated it multiple times, and it primarily serves as a recording studio today. Our team has grown a little bit. We're at 30 employees strong today, and they are all fantastic people. You got a handful of them over here today, which you'll enjoy speaking with them. All right, let's share some stories about clients we've worked with over the years. And these will all focus on clients we've worked with that have primarily leveraged their policies for real estate. First, we've got Mazen and Raseh. So they are 2 doctors, they're a married couple, who own a practice down in Naples, Florida. When I connected with them, they actually wanted to transition out of their full-time practice into real estate, mainly because it was taxing primarily on the husband. He was just getting worn down. So they're like, this is what we want to do. So what we did as step one is opened a whole life insurance policy on each of them. So they're each putting $100,000 per year away into their policies with the goal to use for real estate. However, they're also using it for their business right now. You can access it anytime, which is nice. Next, we've got Tom. Tom owns a $60 million real estate portfolio. Now, he's got multiple policies with millions of dollars in cash value, and he primarily uses the cash value as a business line of credit for property improvements and also new purchases. That is how he uses his policy. In fact, earlier this year, he borrowed $1 million from one of his policies, for a multifamily deal. And before he borrowed against it, that $1 million was earning about 5%. The $1 million he pulled, he's still earning 5% on that while it's in his real estate now. And he also pays the loan back on his terms, not the bank's. He particularly likes that control element. Next, we've got my friend Max. Known Max for a long time. So Max invests in commercial real estate, and his story was he was tired of one bank telling him for a strip mall him and his brother owned, we're going to cut your line of credit in half because the market has changed. So they told him, like, we've got plenty of equity. We're always on time with our payments. What do you mean? The market has changed. You know what? I'll do it myself. That's what he said. So he started some very large policies. Anytime he needs to get money, he gets it within 2 to 3 business days. Very convenient. He doesn't have to deal with banks. And what he did with his policies is he's funding about $600,000 per year in order to build up that balance to where he wants it so he can invest in some larger deals. Let's talk a little bit about the product. Cash value life insurance. You'll see that it's a safe, liquid, and tax-free area to put money. Tax-free if we follow IRS rules. We can talk about later. Let's start with the basics though. Has anyone not really looked into whole life insurance before? Or is it fairly new? Couple. Okay. So with a whole life insurance policy, we've got our 3 colors: blue, red, and green. We'll start with blue. That's our death benefit. With a life insurance policy, you'll find that the death benefit gradually increases over time. And when we die, it's paid out 100% income tax-free to our beneficiaries. The beneficiary could be our family, could be our business, could be a trust, could be a combination of all 3. Then we've got the premium and PUA rider. We're going to explain exactly what those terms mean in a little bit, but they both represent how you pay money into a life insurance policy. With a whole life insurance product, you think you have to pay premiums for your whole life? Hence the name of the product? You don't. You're going to see examples where you can stop very early. And then we've got the cash value. Here's what everyone's interested in, because it goes nowhere but up over time. So what's attractive about it? A lot of things. There's 3 things I like in particular. I like to call them the core benefits. The first one, the cash value is a safe place you can put money. What does that mean? First, it's not invested in the stock market. You'll see guaranteed cash value interest rates, typically between 2 and 4.5%, depending on the company and product we select. However, when you look at the net returns of real policies that have lived the test of time, they usually grow somewhere between 4 to 5%. Some examples you're going to see at 5.5%, but 4 to 5 is a much more conservative expectation, in my opinion. It's liquid. You can access your money anytime you want. It can be as early as 10 business days after we start a policy, and our money keeps on compounding when we borrow against the policy. And then, if we follow IRS rules, we can also access it completely tax-free, which is why a lot of people are interested in it. So who actually does this? Who puts money here? A lot of people. So do these guys. If you look at banks, in fact, most of the major US banks put as much money as they can into cash value life insurance. What I mean as much as they can, because there are regulations as to how much a bank can actually put into cash value life insurance. Now, Bank of America, I've got $24.1 billion, got to update that. It's north of $24.3 billion today that are just in the cash value holdings of their policies. What that means is the life insurance piece that's paid out when people die is about 3x that dollar amount. Massive. Corporations also put money here. I picked these three for a reason. One, everybody knows who they are. But second, if you look at the early days with these companies, all of the founders own whole life insurance, can actually learn that they all borrowed against the cash value of their policies to keep their businesses afloat, which is interesting. And then you'll also see wealthy families. Now, definition of a wealthy family to some might be $1 million, some it might be $100 million, but you'll see families use these products, one, for the cash value, because they'll access it, and then two, the death benefit. Often you'll see a trust own multiple policies or multiple trusts, but a trust owns multiple policies on each family member. And as each family member passes, the death benefit, paid income tax-free, back to the trust, which stipulates how the money can be used for the family, also known as generational wealth. Let's talk about some of our clients. Earlier, I mentioned that one of our biggest clients is a bank. Here's the bank that we work with. So they are a community bank. It's not a mega bank like Bank of America. They're valued at about $1 billion in assets. I started working with them in 2020. They started with a $10 million deposit. They liked the product so much that the next year, they made another $10 million deposit. And then earlier this year, 2025, I met with the chairman of the board and also the CEO. The chairman asked, what are rates right now? At the time, they're a little bit more than 4.6%. But all right, let's do another 5 million. Just like that. Explain why in a moment. So thus far, they've deposited a total of $25 million starting in 2020. And today in 2025, getting close to $30 million. These are their actual policies. It's a combination of multiple policies with multiple companies. The death benefit is north of $65 million. How does that work? Death benefit, life insurance on a bank. Does it go on the brick walls of the bank? No, it goes on their employees. So this bank has multiple policies on about 30 employees. And how it works is as each employee passes, life insurance proceeds on that employee are paid back to the bank. Now, what this bank does is they set it up where a portion of each officer's salary is also paid to their family if anything happens, as they're close with most of their employees, so they care about that. But that's not why they put the money here for the death benefit. Earlier this year, when the chairman said, hey, no brainer, here's another 5 million, he did this because the cash value grows safely, and he also likes the tax benefit. That's why he did it. Next, we've got a hedge fund officer. I'm not going to mention his name because a couple people here might know who he is, even if I mention his first name because he's been interviewed on some money channels. He's worked for JP Morgan. They actually shipped him overseas to Hong Kong for 6 years to lead one of their divisions. He's worked at Goldman Sachs and knows most of the executives there. His story, when him and I connected, was that he had about $5 million sitting in a money market. The reason why it was there, he kept it liquid for opportunities. That was money he wanted to use whenever the market would crash. Now in that money market, he was earning between 4 to 5%, but he's in the highest tax rate. He's getting killed with taxes. We talked about cash value life insurance. He was interested in it. He looked at it in the past, but he was interested in it because he saw that the cash value grew safely, and he also liked the tax benefits that came with it. So his specific plan, here's exactly what he's doing. He's funding about $2 million over a 4-year period and then pays nothing after that. The break-even point, which means first year cash value is greater than what I've paid in, is year 4. So he's cash positive at this point. Now we've got dividend rates and such for the life insurance policy. He didn't care about that. He wanted to know what the annual yield is. Hedge fund officer, numbers guy, one of the fastest processors I've ever spoke with. We looked at the annual yield. It peaks at about 5.45%. Then he looked at this, brought this up, taxable equivalent. What this means is if he keeps the money his money in a money market, you need to earn close to 9%. Then after paying taxes on that, he'd be left over about 5.4%. Because again, he's in the highest tax rate. I'll just put him in a life insurance policy. Like, why would I not do this? It makes sense. Did this because, again, of the tax benefit, then also no risk, similar to a money market, liquid without any risk. And he said this, which I liked a lot because it's coming from somebody I respect a lot. He said, when I compare cash value life insurance with other fixed assets at some of the top hedge funds in the world, he mentioned Citadel, who specializes in fixed assets. He said the net results are about the same, but I don't have any minimum $5 million buy-in or high management fees either if I'm a buyer. Then he said, it's a crime that more people don't understand how this actually works. Think he put money here if it's a bad idea? No way. Then we've got Greg. So Greg's a real estate investor. He started his policy right around the time I got married in 2015. And these are the actual results of his policy. You'll notice it goes from 2015 up until now, 2025. So when we connected, he was interested in cash value life insurance because of the safe growth, the tax benefits, but mainly he wanted to be able to use it for real estate. I've actually got to see him do that with his son over the years too, while he's leveraged the policy. It's been pretty cool to see. Now, at his stage in his life, he's no longer paying anything into this product. Here's what I want to focus on. Look at 2020 through 2022. Where are interest rates? Bottomed out right at the height of COVID, without any risk, no relationship to the market. He's earning just under 5% per year. Doesn't have to think about it. This is the net annual yield. This year, it'll produce just under 5.5%, which based on his cash value comes out to about $56,000. Again, as long as we follow IRS rules, he can use that tax-free, which he's been doing. So why people we work with put money into this product, usually for these 3 reasons. It's a safe place for their money, they can access it anytime, and it's got a nice tax benefit. Someone asks me, why do people do this? Those are usually the reasons why that our clients express. Now, while all of that might have sounded good, you can still really mess the product up. So let's talk about getting life insurance right. I'm going to go over, before I do that, is what not to do versus what to do. So let me ask this. Have you ever looked at a whole life insurance policy and said, oh, this thing's ugly. I don't get why anyone puts money here. It's like a ripoff. Heard that many times over the years. It can be a bad place for your money. At the same time, it can be a great place for your money. Like, how does that work? It's important to know what not to do versus what to do. Because people get ripped off with this product all the time, and it's usually due to a result of not knowing. Like, I don't have the awareness. Here's often what happens. You get a whole life insurance policy. You're told it's a great deal, and you're going to have a ton of cash value, but these 2 words are slipped in there, long term. You put a lot of money into the product, but then as you start to look into it further, you're like, wait a minute, where's my money? Why is it taking so long just to see any kind of return here? You find out you were sold a bad policy and you feel like it was a scam. Quick story about Doug the doctor. This is a true story, by the way. This happened very early on in my career before the executive benefits planning firm. He had read a book about how you could use life insurance as your own bank. After reading that book, he was interested in a whole life insurance policy. Walked into the office, he met with the owner of the firm and also a manager there and said, I want to put $100,000 per year into this product. So they sold him a whole life insurance policy where he put $100,000 per year into it. Here's what he was sold. He paid $100K. First year, can't see that number. He's got about $3,500 in cash value. So what that means is if he said, I don't want this anymore, he'd lose about $97,000. That'd be the hit. By the 10th year, paying $100K per year, he's paid in a total of $1 million. He still don't have $1 million. It's not until the 11th year where he finally gets his money back. 11 years, just to break even. What do you think I'd get paid on this? $85,000. This is actually a low commission product. Some go as high as $134,000. What? That was ripped off. Here's an interesting stat. A little bit more than 90% of whole life insurance products that are sold like this. Just traditional, old school, whole life insurance. Life insurance first, you have cash value eventually. Here's what Doug didn't know. He could have had a policy with the same product, same company, just set up differently. Let's take a look. The exact same product with the exact same company here. He's paying the same $100,000 per year. In the first year, instead of $3,500, he has about $88,000 in cash value. And he's cash positive instead of taking 11 years between 3 and 4 years. What do you think the agent would make on this? Not as much, close. Still pretty good. I would make just over 11K if he went with this particular policy. But if you look at the year 15, he's got about $200,000 more in cash value compared to the first option. Again, same company, same product, just set up differently. What does that mean, setting up differently? Let's go through some details. Remember that chart, the basics? And in red, we had the premium and PUA rider, like how you put money into a policy. All right, so the bad policy first. Doug paid $100,000. 100% of his payment all went toward the base premium. So what that means, the base premium of a life insurance policy, those dollars prioritize life insurance first and cash value second, especially up front. The bad policy, because it all went toward premium, he didn't have much cash value up front. The good policy pays the same $100K. Only 10% went toward the premium, which was as low as we could push it. The other 90% went toward that PUA, which stands for paid up additions. I like to call it a cash dump-in. The reason why is because money I pay here prioritizes cash value first and life insurance second. So in the good policy, because we put more money toward the PUA or cash dump-in piece, I've actually got cash value up front. The lesson. Make sure the policy is set up for high cash value. Otherwise, we might feel like this guy again, which now we don't want to be like that. So with all of that said, that we went through that, why do people still get a bad deal with whole life insurance? Like, why does it happen? Usually because they don't know. Simple as that. They don't know where to start, they don't know what questions to ask, and they don't know what to look for. Be like me, meeting with a doctor. they diagnose me with a certain illness and they say, you're going to have multiple surgeries. You're going to have to go on these 10 medications for the rest of your life. It's going to change everything that I do on a daily basis. But then you look at my diagnosis and say, I don't need any of that. In fact, I've had multiple patients with that same diagnosis that all we had to do was make some big changes to their lifestyle, but they've been okay. I don't know that though. I don't know what to ask. Same thing happens with a life insurance policy of all things. So what do I look for? First, make sure the policy is set up for high cash value. Here's what this actually means. Whenever I pay $1 in, I would look for somewhere between 80 and 90% minimum of that payment immediately available in cash value. Second, I'd want to see that break-even point, which is when I'm cash positive, somewhere between 3 and 5 years, regardless of the company and product. So if we look at the good policy, get about 88% of his 100K in cash value immediately, and he was cash positive in year 4. The second thing I look for, I'd get a flexible policy. What does this mean? That red column, the base premium, I can set it up where I'm only committed to that, and then I can add more money toward that PUA piece, which is the cash dump in, at my leisure. I've got my friend Lance, who started his policy in 2019. He's a real estate investor. He wanted a policy where he could put away $120,000 per year, but he was adamant multiple times. He said, listen, I like this. I do not want to be on the hook to write a check for $120,000 every year. He could fund it. It would just stress him out. He's in the mortgage industry. He lived through 2008. He doesn't want that. So what we did, set the policy up where he's billed for a minimum of about 13 grand. Like, all right, I could do that in my sleep. So we set it up that way. And then at his leisure, he can add up to 120K per year. But again, he doesn't have to. He has in order to grow that cash value though. And then the third thing, I always recommend a major mutual company. And this goes back to my days at the executive benefits planning firm. People get buyer's remorse a lot of times with these products is when a projection shows these great looking numbers and then under delivers. What's going on here? So we always look for companies that can provide proof of performance. Like we like to see policies that are 10 years, 20 years, 30 years old, examine what someone has paid in, what the cash value is, and does it actually deliver, or is it a bait and switch situation? And those are the 4 major mutual companies. Regardless of who you work with, I would always recommend considering at least one of them as you review numbers. And again, this is a focus on whole life insurance. Specifically, there are other products or companies that specialize in other products. Oh, so those ones are all US-based companies that I had up there. Good question. 3 things to look for. Make sure the policy is set up for high cash value. Get a flexible policy. Then I'd also recommend major mutual. Because clients of ours that have followed these steps have a lot of cash value. Fun stuff, right? Life insurance. You got to make it exciting. Very boring name when you look at the product. All right, let's have some fun. We're going to talk about how you could use a life insurance policy to invest in real estate, and we're going to analyze the numbers in this situation. So how does it work? Pretty simple. I take a loan from my life insurance policy. Here's the key though. When you take a loan from a life insurance policy, you keep earning dividends and interest on your entire cash value. Similar to what we talked about with Tom with the $60 million real estate portfolio. Now, if that's confusing to illustrate, pretend you've got $1 million sitting in the bank, it's earning 5% per year, and you pull $500,000 out. Your bank, though, says to you, you know what? Because we like you so much, we're going to continue to give you 5% as if you still had the full $1 million there. That'd be nice. Banks don't work like that, though. It'd be nice. But life insurance does, hence creating your own bank. Your money keeps on compounding for you when you borrow against the policy. Now, sometimes people ask, a lot of times people ask, how? How does the insurance company actually do this? Two ways. Anytime you take a loan, they reduce your death benefit by the amount that you borrow. And two, while they credit you interest on your entire value, there's still also a cost to borrow on the amount that we loan. That helps offset the fact that they're giving you interest and everything. So let's look at a case study. We're going to look at funding a policy for 5 years. We're going to look at a $300,000 property, and then we're going to analyze the net returns on the policy and also the real estate investment. First, we'll look at the policy, then we'll add the real estate to the equation. All right, so here we go. We've got someone funding a whole life insurance policy, $100,000 per year for 5 years. After that, he pays zero forever. You'll find at year 6, which is when he's 50 years old, his cash value is just about $535,000. If he just lets it sit and grow, we look at 58 toward the bottom, it's worth almost $755,000. Slow and steady. That's what it looks like if I let it sit and grow. A lot of numbers. Now we're going to look at the loans. Same policy, but I'm going to take a $300,000 loan from the policy. Now, if I'm you, I would ask, when I take a loan from this policy, like, how does it actually work? Show me the impact on both my cash value and my life insurance amount. Well, at age 50, after the loan, it's worth a little bit more than $200K. Before the loan, it was worth a little bit more than $500. It did go down. However, you're still earning interest and everything. I like to liken the cash value to equity that I have access to. Death benefit is reduced dollar for dollar. It was 1.8. I took $300,000 in the form of a loan. Now it went down to 1.5. Now we're going to pay the loan back, which we don't have to, but we're going to in this example. So you can see how it works. We're going to pay it back at $50K per year. You can see how much goes toward principal and how much goes toward interest. There's your loan balance going down. And here's the question. What does the policy look like after the loan is paid? A lot of numbers. I want to zoom into the bottom. You've got no loans to the left. The example where you loaned and repaid to the right. They're both worth $755. The death benefit, both of them, $1.8 million. Your cash value kept on compounding even though we used it. What it means is that you can use the cash value to purchase real estate, while at the same time when you're using it, it's compounding somewhere between 4 and 5% annually. This is exactly what our clients do. Put their money in the policy, earns a return on the policy. Then use that same money to earn a return on real estate or their business, if they're using it for their business. Sometimes we hear folks express, I feel like I'm getting 2 rates of return on $1. Here's the thing that most enjoy. They don't have to deal with long turnaround times or a bank. Sound good? What's the catch? Always a catch, right? You want to know our numbers, because it can go south. So what I like to look at is, what is my policy growing by? Cash value growth, specifically dividends and interest that I get from the insurance company. What am I paying to the insurance company? That's the cost to borrow. And then if I'm using it for real estate, what is my real estate producing? Here's an easy way to look at it. Take the growth you're getting on your cash value, subtract the loan interest you're paying, then add your real estate to it. What the insurance company gave me, what I gave them, what my real estate gave me. That's what we're looking at. Go through one at a time, and then we'll add it all up to see the total return. So the yearly growth, he's paying $100K per year, going back to this model. First year cash value, $92,300. The growth is negative. He took a loss, $7,700 in this example, 7.7%. This is often the drawback, by the way, that everybody tries to hide. There is a drawback. The first year is the worst year, and it takes a few years before I see that positive return. Now, if we look at the 10th year, his cash value, $663. He pays nothing the next year, and the cash value has appreciated to $663, which is about $27,000 in growth. So again, the growth that we're looking at here is how much money he's received from the insurance company each year. Loan interest. This one's pretty simple. We always know how much we're paying in interest. So if we take that $300,000 loan, at its peak when he paid the most interest on that, in year 7, it was $16,680. Loan interest is simply what I paid to the insurance company in 1 year, in this particular example. And then we've got the real estate. The real estate, got a property value, 300 grand in this case. We're gonna use 10% for the return, just because it's easy math. 10%, 300 grand, $30,000. Annual return on the real estate, what it paid me in income. Pretty simple. Let's start to look at the net results, shall we? Cash value growth minus loan interest. This is just the policy, not the real estate yet. So, if we look at year 7, what do we got? I earned $23,000 in change. I paid $16,000 in change, which gives me a net about $7,200. I could pause there and just buy a car with it. I could do whatever I want with it. I still have that positive spread in this case. Now, if I made that loan $400K, that spread would not be as favorable. But we want to know the numbers. With this example, let's add the real estate return. All right. So how we're going to do that, we've got our whole life insurance policy. We take a loan to purchase the real estate because I'm getting 10% in this example, which is $30K per year. And I want to add that to the equation to see my total return. Like, this is exactly what our real estate investor clients look at every single time. So I've got the real estate return. In this example, 30 grand. We're adding it to the net return we saw in the policy of the $7,200 and change. Add the two together. There we go. That's the net return. It's just year 7. It's also when the interest was the highest in this particular example. What about when the loan's paid off down at year 15? Well, the cash value is still compounding on an annual basis. Growth that year, 33K and change. Real estate return, 30K and change. See what's going on? Add the two together, there's my total return. I earn interest on my entire cash value. I pay interest only on the outstanding loan, and I also earn a return on my real estate. Lesson? Your money keeps on compounding, even when you borrow against it. All right, that was a lot. Let's recap it. So, I get a whole life insurance policy. See that it's earning 5% per year. I then see a property. I say I want it because we'll pretend it's earning 10% per year. To get it, I take a loan from my life insurance policy, buy the property. I can then take some or all of that 10% earnings and use it to repay some of the loan. And all the meanwhile, while I'm doing this, I'm seeing the policy continue to compound by 5, and I'm earning a return on the real estate, all with the money that I initially used to fund the policy. So it keeps on compounding. In summary, people we work with use whole life insurance usually for real estate because it's a safe place for their money. It's easy to access and it keeps compounding. And if I follow IRS rules, which is mainly on your agent, it's tax-free. Now that you've learned a lot about the exciting product, cash value life insurance, and how you could use it, let me ask a few questions. 1, do you see why banks, corporations, wealthy families put money into this product? You see some of the benefits behind it regarding the cash value. You see how you could get the right policy, specifically what not to do versus what to do, how to avoid some of those mistakes. Then you see how the numbers work, or how we can analyze them when we factor in the growth of the policy with our total return. So from here, we've got 2 choices on the home stretch. 1, I might need more information. 2, excited to implement or talk more. Let's talk more about information first. So if you'd like more information, you can stop by our booth, our table. We've got our team over there. We've also got Stephanie here. She is our top associate, has been with me at the company for 8 years now. I don't know where time goes, but she can absolutely get you more information along with her team. We also brought free books and guides we put together, and the guides are tailored toward the presentation you just saw. So you'll see the same charts, same loan models, same net returns. So we've made those available. And then also we've got our website and also our YouTube channel where we've got a ton of case studies, especially if you're interested in how you can leverage the policy. Also, what I always like to mention is if you are interested in seeing how it works first before talking to anyone, because I'm like that myself, like show me something first and then I'll talk with you, we can do that for you. So we do have a one-page intake form that just asks a few questions. It lets us put some different proposals together for you so you can get a sample, just a general idea of what different companies and products look like. You can also scan the QR code. It's the same one at our booth. We can make it available to you and we can provide those numbers. And if you are interested, let us know. You can let me know, you can let our team know, and we can certainly talk while we're here. We're here all evening and also tomorrow, or we can set up a time that is convenient for you. What I do just want to say is if you at any point decide to work with us, if you text us, I got my cell up there, just say Wealth Tax Conference, just because we will make sure that you'll work with myself and Stephanie, who again is our top associate here. This way you've got the best on our team helping you. So with all of that said, thank you. And with the time remaining, let's have some questions.
All right, so we do have a few questions online. We're just going to start with, can you decide how the money you put in life insurance is invested in?
Got it. So with some types of life insurance, yes. With whole life insurance, no. So what we have with a whole life insurance product is first a minimum floor. That's our guaranteed interest rate. And then if the insurance company has a surplus for the year, they'll add the guarantee plus that surplus. That's considered the total dividend interest rate. So it's a lot just like a fixed asset. When you look at whole life insurance policies with those companies and when it's set up the right way, not the bad way, typically we've seen them do between 4 to 5%. Some are a little bit stronger, like Greg's policy, about 5.5% it's doing on a yearly basis, but we don't pick any of that. It's just set it and forget it in many ways.
Awesome. Next question. Who determines the amount of loan interest?
Oh, good question. So the loan interest rate is determined by the insurance company. You'll see both variable rates and fixed rates available. If it's fixed, it's fixed. So some companies have a fixed rate at 5%. One's got a fixed rate at 4.76%, and it's contractually fixed. So what that means is forever, it's not going to go up. It's fixed for the life of the contract. And then if it's a variable loan rate, it can adjust one time per year on our policy anniversary date, which is a fancy word for a premium due date when we get our annual statement and everything. And that's linked to Moody's corporate bond index. They're right around 5.5% right now. Yeah.
Last question from the online audience. Why would life insurance companies allow this?
Oh, really good question. So with a life insurance policy, what I always like to say there is remember, the worst year is the first year, where I'm not getting that 4 to 5% initially. I've got that negative hit. So they make the money up front there. Also, from the educational curve, if you want to call it that, a little bit more than 90% of policies are sold the bad way, which are most profitable to the agent, but also to the insurance company. It takes 10 years just to get your money back. So that hurts a lot. So they make a lot of profit there as well. So they do make their money and they're quite good at it, particularly in the early years is where they're taking that money and putting it to work.
Yes. Steve, two questions. Question number one, are you only using a whole life policy to do this, or can you use a UL or anything else?
Yeah, so you can use a UL. With a UL, there are some differences with the product structure itself. Our company does specialize in whole life. That is really what we primarily focus on. But to answer your question, you can do that with universal life. Any product that has cash value and allows you to borrow against it, you can practice that concept with.
What's the difference between universal life and whole life?
Yeah, good question. So a whole life insurance policy is definitely more of a fixed asset where I know what I'm going to get, 4 to 5% year over year. I've got a guaranteed cash value interest rate that'll always exceed the cost of insurance. Whereas with a universal life insurance policy, what I'll find is that the guaranteed rates are typically lower than the cost of insurance. And the cost of insurance gradually gets higher, slightly more risk, but you also got a lot more upside with a universal life insurance policy. Particularly if it's indexed or variable, now all of a sudden you've got some upside potential with the market. So you do have the greater potential for earnings with a universal life product, but a little bit weaker guarantees. So you will see some differences when you examine the two. Yeah. Yeah, well, so that's definitely a big benefit. And you'll find that that's actually the case with a lot of cash value life insurance products, because life insurance, just as an asset class, does offer creditor protection. Some states have funky rules where it's always good to dig into it, but most states do offer that creditor protection. If you do run into a lawsuit and you just own a policy individually, like it's not owned by an LLC, a trust, nothing fancy like that, you do have a means of that asset protection.
Steve, can you say more about if we wanted to do cash value life insurance policies on employees?
Oh,
Are
yeah.
you doing just executives? Can we do, if you have 100 employees, would you put it on all 100?
Yeah, really good question. So most companies typically start with their executives and highly compensated officers. To answer your question, you can put it on all employees. Why most start with their highly compensated employees is because in addition to the company owning the cash value, having the cash value as an asset in the balance sheet and key man insurance, because they get the death benefit when the employees pass, it's also used as a deferred comp plan. So for example, if I worked for you, what you could say is, Steve, I want you to stay with my company for the next 20 years. And if you do, I'm going to pay you $100,000 per year from the time you're 65 until you're 85 in retirement. But you got to stay with me 20 years to get that. Golden handcuffs. You're retaining me and then rewarding me. A lot of life insurance companies, what they'll use is like cash value life insurance. They'll build the cash value up. You take that policy out on me. You now have key man insurance. But then when I eventually retire, you're not going to compensate me from your revenue. You're going to use the cash value that you built up over time. And what a lot of companies do, like the kicker at the end, will always set those up where you don't just drain the policy. So you have this death benefit. So when I eventually die, whether it's prematurely or when I'm 85, company gets that death benefit back income tax free.
Is there any taxes on that?
Say it again.
Is there any tax on that?
On the cash value growth?
No, like, let's say you die, that $2 million comes back to the corporation.
So yeah, so death benefit proceeds on life insurance are paid income tax free. With corporate plan, like when a corporation owns it, it does need to be set up that way from the start where the corporation owns it. You typically can't change ownership after the fact. There's some laws to be aware of there, but do it right. I mean, you've got the tax-free benefit, which is why you'll see a lot of companies do it. Go back to his question, yeah.
Is that 100% expense for the company?
Good question. So it's not. No, that question always comes up. So it'd be comparable to a Roth account in the sense that money I fund is with after-tax dollars, then IRS language, gross tax deferred. Then if I follow IRS rules, I can access it tax-free. Yes?
Steve, you showed us two examples of very similar pay-in, and then one example, the first year was 3,000, the other example was significantly more, like 87,000.
Yeah.
And then you showed us that the agent gets 85,000 with the first example and 11,000 with the second example.
Yes.
That's a huge difference. How do I, as a customer, know that my agent is giving me the best value? Because I see a conflict of interest here.
Yeah. Mm-hmm. Yeah, really good question. So there's two ways you could approach it. Actually, three. One, if you've got a relative in the industry, you could ask them, hey, what are the rates on this? Right? If you do have a relative in the industry or someone you know. Two, the steps to follow. If I look at a life insurance policy and find that it's very cash rich up front, like I put in $1 and I've got 80 to 90% of that dollar available immediately, that almost always results in the lower commissions to the agent up front. So that's one way that you can look at it just on the surface and know, if I've got 80 to 90% of whatever I paid in cash rich up front, that usually results in the agent making a lower commission there. So that's one way to look at it. The other way is you could ask the agent, which sometimes is uncomfortable, but anyone can ask. Like our big thing at our company is transparency, showing everything, and you can ask. Thank you.
Really well laid out. So you start a policy, you start funding it. When can you start pulling that loan? How much equity do you need? I mean, is that after a year or is it a percentage of the cash value?
Great. Yeah, great question. So whatever you have in cash value, you can typically access up to 95%. So if I've got 100 grand in cash value, I can access up to 95% of that. When can I borrow? Is typically as early as 10 business days after I start the policy, so I can access it early. The only thing you want to be aware of with that, remember the drawback, like the first year is the worst year? So he paid in 100 grand, he had a little over $90,000 in the first year. He's got access to that. But what I'll say to a real estate investor or engineer, we work with a lot of analytical folks, to say, the one thing just to point out is you do have a negative return in the first year. Just if you park the money and let it sit and grow, year one, you're negative. You borrow, you also have that cost of insurance. So if I'm you, I just want to see that up front, see what my total costs are, and see how long it takes to make up for that as the policy compounds.
Part of the benefits in working to my system, they switched us to whole life insurance with the option for specific policy, like $1 million, I believe, benefits for life insurance, whole life,
Yes.
with the option of funding.
Mm-hmm.
Would you encourage using this opportunity, or it's going to be too restrictive being through your employer?
So really good question. Typically, and correct me if this is not the case with you, typically whenever it's plans that are available to a group of employees, there's usually no medical underwriting. Like I don't have to go through a medical exam or anything like that. So that's called simplified underwriting in many cases. So what that means is when you look to get a policy like that, where you can throw extra money into it and see the cash value, a lot of times that might not be available or there are restrictions there. So to answer your question, it's possible, but a lot of times you'll find it is difficult compared to just an individually owned policy.
Because they are encouraging us to
Fund it with own out of pocket.
with your own money. On top of that, you use
Yeah, got it. So the use is nice. So the one thing that I would dig into there is like, okay, you're encouraging me to fund it. When I put $1 in, does it go toward that premium piece that doesn't give me cash value up front, gives me insurance? Or can I put it toward that PUA, the cash dump in, where it's there for me and I can use it? So that's the one thing that I would really drill into to make sure that you can use it how you want to.
Thank you so much, guys.
I work with him now. We've been working with him for about maybe 5 years, and it's really great working with his team. They are always available, always very knowledgeable. They give you all the information you want. So I do encourage you to at least talk to them.